Welcome back. We are now in chapter 6, and in this chapter we'll be discussing about the balance sheet. So please recall in the previous chapter, chapter 5, we had discussed about the P&L account. So in the profit and loss account, we have taken all possible items that can appear in a typical P&L account. We have discussed what each item means, what is the treatment to be given in the CMI data, and what are the points you have to be careful when encountering certain items. So in a similar way, we'll be now discussing about the balance sheet. We'll be having a look at all the possible items that can appear in a typical balance sheet. We'll discuss item by item what the specific item means, what is its importance, what are the aspects you need to look into when you encounter that item in a balance sheet, and what is the treatment you need to give in the CMI data. So before proceeding further, let us look at a blank CMI format and see how the balance sheet looks in the CMI data. So just as in P&L account, here also we'll be having the last 3 years actuals. So say for example we are in December 2013. So since 2012-13 is the last completed financial year. Since 2012-13 is the last completed financial year, you have to provide financials for the last 3 actuals, last 3 years actuals. So for the year 2011, 12, 13. So 3 years actuals will be presenting in the CMI data. Sometimes, as we already discussed earlier, sometimes banks might also insist what is known as provisional balance sheet, right? Provisional financials. Since it is 9 months since the close of 31/3/2013, since December is 9 months, so sometimes banks might also ask you to submit say June or September, some provisional financials which are of more recent date. So in this example we have September 30th provisional financials, and then we have 2 years estimate. So we have 2 years estimates, that is 14 and 15. For working capital usually you have 2 years projections. If it is a term loan, you will be providing projections till the closure of the term loan. For example, as per the proposed repayment schedule, if the term loan is expected to close on 31/3/2017, so you'll provide projections up to 17. If it is only working capital, 2 years projections are usually sufficient, right? So what you usually find in a balance sheet under the CMI data is the liabilities, right? You'll be bifurcate into current liabilities and term liabilities, right? The liabilities will be bifurcated under current liabilities and term liabilities, and under the asset side you have the long term, you have the current assets and non-current assets. Non-current means long term, right? So again here also you'll have current assets and non-current assets, and this bifurcation is very important from a banker's point of view. CMI data provides this bifurcation because as a banker you need to know this bifurcation. Why is this bifurcation important? We'll be covering in the future lectures, but please note that you need this bifurcation absolutely. This bifurcation is not actually provided to the full extent of the balance sheet. In a typical balance sheet prepared by the company, right? You have these items like what are these current assets, some heading will be given, some bifurcation will be given, but this classification is very important to bankers, more important than what the company provides. So we have specific items classified into specified groups, whether it is a current and term liabilities. Why is that so important? We'll discuss later, but for the moment please understand that the liabilities will be classified under current liabilities and term liabilities, and assets will be classified under current assets and non-current assets. So if you see here the liabilities, we are starting with liabilities. We'll discuss each item later, but for the moment just see the format. In current liabilities you have various items like short-term borrowings from banks, creditors, advance payments from customers, and so on. This classification here is the current liabilities. So you have the total of current liabilities. Then you go into the term liabilities. So in term liabilities, what are the items you require is the term loans from banks, shares, debentures, right? You can have all these liabilities. Then this net worth, that is the owner's capital and reserves and surplus. All these items also are part of a long term, like share capital, reserve and surplus, and all this also a part of the net worth, that is a long term liability. So liabilities will be have a current liabilities and the long term liabilities. In the long term liabilities you have outside borrowings like bank term loans and other borrowings, and you also have the owner's liability. This also we spoke earlier on the business entity concept while discussing chapter 2. One of the accounting concepts is the business entity concept. There we discussed that owner is just an outside party who has lent funds, so this is also liability and it's a long term liability. So outside funds and owner's funds. So this is the classification you have in the CMI data. This is current liabilities and long term liability. Then when you come to the assets, you have the current assets and non-current assets. So under current assets you have cash bank balance, receivables, that is the debtors, and you have the inventory, that is raw material, work in progress, finished goods, right, stores and space and all this. You also have the other items like provision for advance tax payment, right, and other various items. And then we have then we go to the long-term assets. Long-term assets like fixed assets, Here you have the gross block, depreciation, net block, which we discussed in the previous chapter while discussing depreciation. So fixed assets, we have something called non-current assets. There you have the investments in sister concerns or other investments. Then you have deposits, various other non-current assets, and then you have the intangible assets, right? So put together, in summary, shortly, you have the CMA data. Balance sheet will be covering liabilities and assets. Under liabilities you have current liabilities and term liabilities, and the assets you have the current assets and the non-current assets. This non-current assets could be fixed assets. This can be non-current assets like deposits and other stuff, and intangible assets. Anything, these are all non-current assets. These are not current. Anyway, we'll discuss each item in the future lectures. So before getting into the individual specific items, let us have an idea as to what a balance sheet is. So in this segment 6.1, we'll be discussing about what a balance sheet is. So before that, in common usage, yeah, please understand balance sheet refers to both P&L account and balance sheet. Strictly speaking, profit and loss account and balance sheet are two separate documents, right? They're two separate statements, P&L account and balance sheet. But like, for example, when your boss asks you, get me the balance sheet of a company, BHEL, for example, get me the balance sheet. Don't just take the balance sheet part and leave the P&L account part. That is not what he meant. Usually, in common day usage, when we mean balance sheet, we mean the complete set of financials of the company. That includes P&L account, balance sheet, and cash flow statement. So, speaking loosely, in common day usage, when we speak of balance sheet, we speak of all the three documents. That is the cash flow statement, P&L account, and the balance sheet. But strictly speaking, from an accounting point of view, as you're going to see, these three are separate individual statements, right? So at the outset, before even beginning the discussion on individual items of the balance sheet, there are two points that I would like to clarify at the very beginning. One is the balance sheet need not be a separate statement. We have discussed that the P&L account and the balance sheet are two separate statements. But what I'm saying is they need not be two separate statements. We can actually have one single statement called the balance sheet and cover all these aspects. I'll explain what I mean by this. Like, I'll explain this. The other point is balance sheet is a stock concept, whereas P&L is a flow concept. So before beginning this chapter, I like to discuss these two points. So this point is something actually we discussed in an earlier segment. Right? I think it was in chapter 4. Right, while discussing, while having a brief introduction to the various statements, we discussed this. So again, I'll repeat here. So what I mean by this is, we have seen the example in the previous chapter when we discussed the P&L account. We have taken the example of Maruti Suzuki and seen the P&L account of Maruti Suzuki, how it looks like, what are the items. So there we have seen various items like sales and raw material. Various items we have seen under the P&L account. So for example, under Maruti Suzuki, we had various, in the P&L account, we have various items like sales and raw material, power, labor, and other expenses. And finally, we arrive at the profit after tax. So we have various figures for each item. For sales, we had, for example, I think 39,500 something, around close to 40,000 crores. And various other, each item had a figure associated with it. Now, please note that when you speak of sales as being 39,500, this is the financial year 2011-12. So in this year, there are 12 months, right? And 365 days. The balance sheet is drawn as on 31/3/2012, right? When we say the sales of Maruti Suzuki is 39,500, we are not saying that, right? We are not saying that the sales as on a particular date, as on March 12, as on this single day is 39,500. We are not saying that. What we are saying? We are saying that starting from April 1st, 2011 and ending till 31/3/2012, for all these 365 days, the sales put together is 39,500, right? Is this point clear? For under the P&L account, right? Under the P&L account, each and every item, raw material, power, labor, any item, what it actually gives you is the cumulative figure. When we say sales, it is the sum of sales, sale made in day 1, that is 1/4/2011. Sale made in day 2, 1/4/2000, 2/4/2011, and so on up to 365th day, that is 31/3/2012. For all these 365 days, what is the total sales? That is the 39,500. This sales is not for any one particular day. No, it is for all the 365 days put together, right? Similarly, when we speak of power, we pay monthly bills, like the company has paid power bill in April, May, and up to March again, that is 13th, this is 12 months, this is April 11th. For this 12 months the company has made power bill. When you're saying power bill is so and so amount, we are not saying that it is the power bill for one particular month like March 12. No, we are saying that sum total of all these 12 months the power bill is so and so. So please understand that P&L account is a flow concept, right? It is not as on a particular day, it is a cumulative position for all the days included in the particular period. So when we say P&L account of an year 12, 13, 11, 12, we mean it is the cumulative each item like sales or power, any item, it is the total of all the 365 days, right, for this period. But when we speak of balance sheet is a stock concept. We speak of balance sheet as on a particular day. So in this example we are going to take another company. When we speak of balance sheet as on a particular date like 31/3/2012, what we are saying is this is the position of the company. We'll draw the liabilities and assets. We'll discuss what is a liability and what is an asset. So the balance sheet gives you the position of the company as on, right, as on a particular date. Right, this is not a cumulative position. Balance sheet doesn't make sense on cumulative. Like when we speak of an asset item called inventory, right? The Maruti Suzuki, for example, had various inventories. For example, finished cars. The companies had some finished cars in its godown. So 800, Maruti 800 and Wagoner, Ritz. Various completed cars are in the godown. These are completed. So this will appear under the finished goods in the inventory of assets. So when we say, for example, there's some, say 2 lakh cars, right? 2 lakh cars are as finished goods as on this date, as on 31/3/2012. It doesn't make sense to speak of balance sheet as a cumulative concept. We're not saying that the total of the 365 days inventory is so and so amount. We're not saying that. As on this date, as on today, the balance sheet figure will be showing the position of the company as on this date. So similarly, when we say debtors, what is debtors? We already discussed. Again, we'll discuss later. But debtors is the amount receivable to the company. The company has made sales and yet to receive amount from the payment from the customers. So debtors, for example, say it is 10 lakhs. Let us say, not for this Maruti Suzuki. For a small company, 10 lakhs is the debtors. When we say 10 lakhs is the debtors, we are saying that today, as on this day, the amount pending from our customers to whom we have made sales but didn't receive payment is 10 lakhs. It is not a cumulative figure as on a particular date. So balance sheet is a stock concept. P&L account is a flow concept, right? So that is the first point that I want to tell you. The second part is, I told you P&L account and balance sheet are two separate statements. That is correct. They are two separate statements, and in practice you are going to see two separate statements. But conceptually they need not be two separate statements, right? I'll tell you what. In fact, this is a concept that I think we already discussed in a very beginning lecture. We did discuss, but anyway, I will explain it again once again here. You see here, in a business establishment, all profits go to whom? Right? All losses go to whom? So can you answer this question? So in a business, when you see a business as an entity, there are various players involved here, right? The owners are there, the bankers are there, right? The raw material suppliers are there, right? We have the customers of the company. There are various stakeholders involved. So if the business earns profit, right? To whom does the profits goes? This might be difficult for you to answer, but this is easy. If there is a loss to the company, to who should bear the losses? So as a banker, if the company says I made a loss today, I cannot pay you the loan, will you accept it? If you're a raw material supplier, the company says I'm in difficulty, I cannot accept, please share my loss, right? You share my loss. For example, you have to make a payment of 10 lakhs to the supplier, but you say I'm in a difficult position, I have made a loss, so please share my burden, I'll pay you only 5 lakhs. Will he accept? To the customers, for example, will the customers like for example, the customers have to pay you debtors is only 5 lakhs, but can you ask them, please pay me 10 lakhs, I'm in difficulty? So who bears the losses? So please note that in a business establishment, all losses are to be borne by the owner. The owner bears all losses, and naturally all profits go to the owner. So that is a risk he's taking. The business risk is all profits go to the All profits go to the owner, but the downside is all losses also go to him. That is the risk he's taking, right? So in a business establishment, all profits and losses go to the owner. That being the case, a business has various incomes, right? And it incurs various expenses. So the income will be sales and various other incomes, and the expenses will be raw material, labor, power, and various other expenses. Ultimately, you will be arriving what is known as profit by deducting the income and expenses, right? So income minus expenses, whatever is the profit, you will arrive at the profit. So just now we discussed that all profit should go to the owner. So if the income is greater than expense, you will have a profit. If it is less than the expenses are more than income, you have a loss. Anyway, profit or loss have to be go to the owner, right? So in the balance sheet, you have something called liabilities and assets. This we'll discuss in detail, but we discussed already briefly this concept earlier. So under liabilities, they have various parties from whom the company has borrowed funds, and these includes the owner, bankers, and various other entities. So we also discussed why we are treating owner as a outside party. Why we are saying we borrowed funds from the owner. That is as per the business entity concept. Anyway, we'll have a discussion later. For the moment, please understand that the owner is also an outside party from whom the business has borrowed funds. Now, under the owner, if you draw a separate statement for the owner, all the transactions for the owner. So what are all the income that goes to him? All the profits go to him. And what goes out of his account? All losses go out of his account, right? So also incoming would be any additional funds which he invested in the business. So owner will be from time to time investing some additional amount, his own capital into the business. That is also an investment, the plus. And what can go out is as personal drawings, right? So if you look at the capital account, right? If you look at the capital account, if the business is to maintain a separate account for the owner, so all pluses will be for the owner. The pluses will be any capital which he brought it, additional capital which he brought it, or any profits. And what will be the negatives? It will be his personal drawings. He can draw money for his personal use, right? And all losses. So this is how this capital account will look like. Now please see this profit. For example, let us not worry about this loss here. Let us assume that the company has made profit. So this profit here, right? This profit is arrived by sales minus income minus expenses. So instead of putting this directly profits, right, you can provide individual items here. You can list all income here under the places. You can write all incomes directly instead of providing the profit here. You can write all incomes here, sales, and all the expenses here. What are all the expenses? Like raw material, power, and labor. Even then you will arrive at the same figure because profit is ultimately income minus expense. So either you take this figure directly and put it here, or individual item you put, because what you are saying? We are saying that all income, all profits will go to the owner, and all losses and all expenses have to be borne by the owner. So this is also correct. So individually you can provide the breakup here, or a net figure arrived through a separate statement called P&L account, where you list all the income and all expenses and arrive at the profit, and the resultant profit you can transfer to the capital account. Either way is correct. There are two ways of maintaining the balance sheet. One is having a P&L account as a separate statement, and one is as a part of balance sheet. So if it is as part of balance sheet, it will be part of the capital account because all profits and losses have to be borne by the owner. So in the liabilities, so this is the balance sheet, you have the liabilities here and the assets here. One of the liabilities is the capital account. So this capital account, if you magnify it, you can list, you can go on listing all income items here and all expenses items here, right? And arrive at the profit. You will get a profit. Resultant will be the profit. Or you can have a separate P&L account, arrive at the profit, and put the figure here. So either way is correct. In practice, we maintain a separate P&L account. You take the income expenses, only income expenses, not the capital infused by the customer, by the owner, not his personal drawings, not this, only the income and expenses. Arrive at the profit and transfer this profit to the capital account, right? Which means your capital account will now include only, under the pluses side, the capital, additional capital infused by the proprietor or the promoter, right? That is the only plus. And other profits. The profit, this comes from the P&L account. And on the negative side, you can have all the his personal drawings for personal use in the losses. So this is what we're doing. So please concentrate on this profit. How are you getting this profit? Profit goes to the owner. Fine. So the way you can arrive at the profit is in the capital account itself, include all incomes and expenses and arrive at the profit, or have a separate P&L account and transfer only the profit part here. Either way is correct. In practice, we maintain a separate P&L account, because if you include, there will be many items under incomes and expenses. So if you put it in the capital one, it becomes cluttered. You don't want a cluttered capital account. Secondly, a more important reason is having a separate P&L account we will be able to analyze the parameters better. For example, if you have the income and expenses under one single statement, you can analyze profit under various levels at various levels. For example, here you get only the resultant profit, but here you can track various profits. For example, you can track the profit at the operation level, EBITDA, right? You can track operating profit. All these we'll discuss later. But the point is, having a separate P&L account will give you greater control, right, in analyzing the performance of the company. So in practice, we have a separate P&L account, and the resultant, the last final figure, that is the profit, will be transferred to the capital account. Alternatively, you could do what you could do. You can have all the income and expenses item here itself in the balance sheet without maintaining a separate P&L account, right? Without maintaining a separate P&L account, you can still have a balance sheet in which all the items will come, all income and expenses. Even that is correct conceptually. Both will arrive at the same balance sheet, right? This is only for convenience. So we have a separate P&L account, and the resultant profit will transfer to the balance sheet, right? So now that we have seen 2 points regarding a balance sheet, let us now actually see what a balance sheet, right? What is a balance sheet? So I will tell you 2 ways in which you can look at a balance sheet. One, it is a statement which records the sources and uses of funds. The other way to look at the balance sheet is the liquidation concept. I will tell you there are 2 ways in which you can look at a balance sheet. When a balance sheet is presented to you, a company balance sheet, you can look at the balance sheet in 2 ways. One, it is a statement of sources and uses. Another, from a liquidation point of view. So let us discuss this. So put very simply, balance sheet is nothing but a table with 2 columns. Balance sheet is a table with 2 columns. So in one column you have something called the sources of funds, and the other column you have uses of funds. See, what is a balance sheet? It's simply a table with 2 columns. In simple terms, right? Let us not complicate it, which we will discuss the intricacies later. But for the moment, just understand the balance sheet is a table with 2 columns. In one column you list all the sources of funds. So from what are the sources from which the business has obtained funds, right? These are the sources of funds. And here you list all the uses. What did it do with the funds? So what purpose for these funds, which were these funds raised, were put to use? What purpose, right? So for what purpose you have put these funds into use? That is what a balance sheet does. So let us take simple events, right? Let us stay away from the companies for the moment. Let us take simple events and try to draw balance. Say for example, you want to buy a house, right? And it costs 20 lakhs. So let us draw a balance sheet for the single purpose. The purpose of this event is pertains to the purchase of a house. You want to buy a house whose cost is 20 lakhs. Now let us try to draw a balance sheet where we list the sources from which you can arrange these 20 lakhs. Now you have to arrange 20 lakhs. So what are the sources from which you can arrange these 20 lakhs, right? And we'll see to what use you have to put these 20 lakhs. Obviously the use here is to purchase the house. That is a single use. Let us see the sources from which you can arrange funds. So see here, in this example, you require a total of 20.5 lakhs. So 20 is the cost of the house, and the other expenses such as statutory charges, load agreement, stamp charges, and all, processing fee, and all other. So 50,000 anyway. So you require 20.5 lakhs. This is your requirement. So as an employee, you are an employee, right? I'm assuming you're a banker. What are the various sources from which you can arrange that 20.5 lakhs? Of course, the major will be a housing loan. So 10 lakhs you have applied for a housing loan. You are eligible for a housing loan of 10 lakhs under the staff concessional scheme. So you have applied 10 lakhs. Okay, that is the a major part. So what are the other sources? You have to pump in your margin, right? You have to pump in your margin. Actually, you'll be eligible for a 20 lakhs loan. You'll be eligible for more than 10 lakhs. Let us assume that you're happy with 10 lakhs. So you have savings that is accumulated throughout your service. So this is in a SB account. So there's some 2.5 lakhs in your SB account. So that is an income, that is a source of income which you plan to use it for the purpose of purchasing this house, right? So 10 plus 2.5. You also have a fixed deposit. This is not in SB account, this is in a fixed deposit, but which you now plan to prematurely cancel it. So that is another 1 lakh. So you have some gold. So you're planning to sell this, right? Or you can pledge it and obtain a gold loan as per your preference. You'll assume that you're going to sell the gold. So then the 5 lakhs. Then you have some relatives and friends who will be chipping in some 2 lakhs. So ultimately, after arranging all this, you fell short by 2 lakhs. So you approach your friends and relatives, and they have arranged to agreed to arrange another 2 lakhs. So the total of this is 20.5 lakhs. So your requirement 20.5 lakhs. You're planning to meet from these various sources. The major source is the bank loan. Your contribution is 3.5 lakhs. Okay, this gold is also yours. So this is 8.5 lakhs. So the remaining 2 lakhs you have borrowed from the friends and relatives. So the 20.5 lakhs your requirement is going to be met from these sources. See here, these are all the sources, and under sources you are also a party. You are also contributing in some way, right? This 2.5, 1 and 5 belongs to you. So this 8.5, you are also a party. Sources of funds means not just outside sources. Sources includes bank and relatives, friends are outside sources, but you are also contributing in a major way. So you are also included in the sources. So sources lists all the people from whom you are going to obtain source to meet this 20.5 lakh requirement, right? So once you get the 20.5, how are you going to use it? So this row, this column, how the money was spent, it lists the use to which you will go to put this 20.5. This 20.5 you're going to buy a house 20 and some 50,000 for some charges, right? Processing charges and other charges, right? So this is not a balance sheet in a strict way, but the concept of balance sheet is very simple. And balance sheet also does the very same thing. It is a table like this. You'll have 2 columns. On one side you'll be listing all the sources of money. From where have you obtained? From where has the company obtained the funds? Who are the people? Who are the institutions who have lent funds to the company? So you'll be listing on this column. And the other column, how was the funds? These funds which you obtained, what did you do with these funds? What did the company do with these funds? So it's going to list in this column. So the concept of balance sheet is very similar to this example which I have discussed, right? This is a example of an individual for purchasing a house, but the concept is very similar. You'll have 2 columns. One will list the sources of funds and other will list the uses to which you have spent these funds, right? Let us take another example. So your colleague is planning for his daughter's marriage. Now let's draw a balance sheet for this single purpose. Only for this purpose, let us try to draw a balance sheet. So first of all, we fill the requirement, because this is where you start, right? You actually should know what is the exact requirement, and then we'll arrange the funds accordingly. So let us fill the second column, that is the uses, right? How much money you actually require. So you require a total of 30 lakhs. This is what your colleague has planned. His idea is the total requirement will be 35 lakhs. The breakup is as follows. Dowry. Okay. We agree that dowry is deplorable. Okay, fine. But for an example, this is from a practical point of view. Since this is in practice, let us as a colleague, your colleague, the major concern is the dowry. So let us have 5 lakhs, and maybe there are some dresses and all. So 2 lakhs. Gold you have to purchase 4 lakhs. There's some dinner, a banquet which is planning 3 lakhs. Then you have a house in the name of the girl. Maybe that is a stipulation which the groom has made. And then a salary loss, since you are not granted 2 days leave, so you went on loss of pay. So that is another 5,000. And all other expenses, let us club together. Ultimately, we arrived at 35 lakhs. So the colleague estimation is that for conducting this marriage, a total of 35 lakhs is required. Actually, this 0.05 lakhs is not required. If you look at it, actually, all these are required for conducting the marriage, right? All these are expenses. This is not an expense, but I'll tell you later why you are taking this, okay? But consider this is also an expense, right? In a way, this is a loss, isn't it? So we're treating it as an expense. So anyway, even if you don't consider, that doesn't matter. Anyway, 35 lakhs, right, is the total requirement which your colleague has assessed for this purpose. Let us see how he's going to arrange. What are his plans to arrange these 35 lakhs? So these are the sources from which he's planning to arrange the 35 lakhs. He has some balance in the SB account. He's a staff in a bank, so he has a COD limit. So there's some unavailable balance, so another 0.5. Some gold is available, so that is 3 lakhs. He already purchased the house in the past, right? So basically this will go directly here. So the he has a house already purchased. Maybe he'll just transfer it in the name of the name of his daughter. So this 20 need not be purchased in the sense that we did not arrange for funds. This is already available. Anyway, there's some shares he has in his name, so which he's planning to sell. He will realize some 1 lakh. And then a personal loan. He also has a son. So his son has applied a personal loan in his own name. So some 5 lakhs is obtained. And on his provident from some loan is applied. So you can see here, this 35 lakhs, the requirement of 35 lakhs is he's planning to meet from various sources. So once again, this is what a balance sheet says. So this is also an example of a balance sheet, right? This is for a single purpose for the marriage. But again, a balance sheet is simply this. Again, you go to see this. Balance sheet is a table where you have 2 columns. One is the sources of funds, another is the uses to which these funds will be purchased. So if you're giving this balance sheet, now you can see he's going to get a total funds of 35 lakhs. And what is going to do with the 35 lakhs? He's going to do all this. He's going to purchase a house. Anyway, this is already there. He's going to purchase some gold, dresses, dowry, right? All other expenses. So balance sheet will tell you this, right? It will tell you the sources of funds and the uses to which these funds will be put into. So let us look at a balance sheet of real life company. This is the balance sheet of HDFC Bank. Okay, so this is the balance sheet of HDFC Bank as on 31/3/2012. So you can see as on 31/3/2012, a balance sheet of HDFC Bank is listing something called liabilities, capital liabilities, and then you have all terms called assets. Right? This is actually so figures are presented for 2 years, 31/3/2012 and 31/3/2011. You need not be worried about the individual items, but look at the point that I'm trying to make here. The point is, here again the balance sheet is doing the same thing. What it is doing, it is listing the sources of funds. All these sources, capital and liabilities are the sources, and all these assets are uses. So as a bank, you are working in a bank, so you know what is the major source of fund for a bank. Bank is into the business of lending loans. That is a major business. So from where does the bank usually gets funds to lend these loans? Deposits, right? Deposits is the major source of funds. And you can see here another sources of funds. See, one of the major source of funds is out of all these items, you can see the major item is this, right? What is this? Deposits. The individual breakup might vary. There will be some savings deposit, current deposits, term deposits, but whatever it is, this is the major source of funds. There are some other sources also, right? There's some borrowings which the bank has made, right? There's some ESOP, capital, okay, whatever it is. So this column will be listing all the sources of funds from which the company has raised funds, right? And what did he do with this funds? So HDFC, right, has obtained this amount. So what did he do with these funds? Did he dig a hole? Did he dig a hole in the ground and hoard all this amount? Right? Did he hoard all this amount? No, he did something. What did he do? That will be listed in the liability. That will be listed in the assets. So what did he do? What did he do with the amount? So what is the major business we said? It's for lending loans. So obviously you're going to find loans. See here, out of this, this is the major item. Loans and advances. To whom it has given? What are the sectors? SSI segment, corporate segment. That is different matter. But these funds, on obtaining these funds, what did it do? It did lend. What is the major loans? You also know that as per RBI guidelines, you cannot lend all. For example, if you receive 100, you cannot lend that entire 100 to the loan. So there is something called some statutory reserves have to be maintained. There is something called CRR and SLR, whatever. So you can also see some investments, because bank has to invest some of these sources in safe avenues. So investments is also another item you can see here. There is some cash and bank balance with the RBI. So balance it with other banks, right? Call and short notice. The bank has purchased some fixed assets. Anyway, what he did with this money, that will be listed in the asset side. So asset side will be telling you the uses. The uses to which these funds obtained from the liability side have been put into. So HDFC Bank has, with that money, lent some money. The major part has lent in the form of loans, but it also made some investments, right? There's a department called Treasury, right? Usually in Bombay. So they deal with the investments. The company might have invested in various, HDFC Bank has invested in various investments, right, in the call market, various instruments. So it also have some fixed assets, branch premises and various other fixed assets. So all is this with this. So how did he do all this with the funds from this liability? So again, this is a real life balance sheet. You can see simply what balance sheet is telling you. Balance sheet is listing the sources of funds in one column, And what was done with those sources? What it was done? Like the uses it will be mentioning on the asset side. So put simply, balance sheet is a table which contains two columns. So I told you there are two ways in which you can look at the balance sheet. One is the sources and fund. This is what we have discussed so far. Sources and uses. So balance sheet is a table which lists sources of funds on one side and the uses of funds on the other side. So that is one way in which we can look at the balance sheet, right? There is another way in which the balance sheet can be looked at. That is the liquidation concept. Let us see the liquidation concept. So let us see what liquidation means. So liquidation means the process by which a company comes to an end. So the company terminates and ceases to exist, right? So when a firm is terminated, so what happens is the assets are sold. So usually the company will be running the business which is related to the balance sheet. So company has borrowed some funds and put all these funds into. So just now we have discussed that balance sheet is a statement which provides the sources of funds and the uses of funds, right? So for example, let us assume that the major sources are the capital is the promoter's own funds, right? Let us example, he has invested some 100 lakhs, right? And there is some bank loans. He has borrowed from loans from banks amounting 700 lakhs, and there is some payments are to be made to the raw material supplier, right? Let us assume there is another 150 lakhs, right? Let us assume these are the major people from whom the company has borrowed funds. So this is 950 lakhs, right? So using these funds which he has obtained, what the promoter did, he has put these funds into use. So he has maybe purchased some fixed assets, land, building, machinery, right? Let us assume this forms 400 lakhs, right? And then there's some inventory, right? Raw material, finished goods, all put together. There is some 300 lakhs. There's some dues to be received from the customers, right? Let's say there's some debtors. So let us assume this is another 200 lakhs. And finally, there's some cash on hand. That is some 50 lakhs. So again, if you see the total, that will be 950 lakhs, right? So this is a simple balance sheet. So let us assume that the promoter right now has decided, today he has decided, he wants to wind up the company. So the company is incurring losses, or he is not interested in the business. He wants to just wind up the company. He just wants to close the company, right? So he files for what is known as liquidation. Liquidation means the business terminates, right? So the business terminates. The company is wind up, right? No more business from today. So now his plan is not to run away, right? He does not want to run away. That's different. But he's a genuine party. The business is making losses. He wants to close up the company and settle all dues. So there is some dues here. There's some dues here because he has made some borrowings. He wants to settle all dues and close the company. No more business from tomorrow, right? So what he does, he sells all these assets and realizes 950 lakhs, right? So he goes to the market, sees who are some parties interested in buying these fixed assets. He realizes by selling all these fixed assets, all this machinery and all this building and other assets, he realizes 400 lakhs cash, right? And there is some finished goods in the godown and some raw material, whatever is the inventory. He sold it. He realized 300 lakhs on the cash from those to whom he has sold these goods. There's some debtors, so he went to the debtors and pursued and realized this. These are dues due to him, right? These are the parties to whom he has sold in the past but didn't receive payment. So he went to them and received these payments. So let us assume a hypothetical situation which is all the parties have paid. There are no bad debts. All the people have paid the entire dues. So 200 lakhs he has recovered from the debtors. So the cash is 50 lakhs. He has gone to the bank and drawn from the bank. So this is in the form of current account or savings account, not savings account for a company, current account. Or maybe fixed deposit. He has cancelled the fixed deposit. So he's got 950 lakhs cash right now. So he sold all these assets, or he realized cash of 950 lakhs from these assets, right? These are all the people from whom he has sold it to various parties, the assets, and realized cash of 950 lakhs. So what he's going to do with this 950 lakhs? So since he's planning to go close the business, he has to settle all pending dues, isn't it? So he has to settle all the pending dues. Any loans he has taken, he has to settle with this 950 lakhs. So to whom he is going to settle, that will be given in the liability side, because these are the people from whom is borrowed from sources. Balance sheet sources lists the sources, the people who has lent to this company, and the owner is also one of the people who has borrowed, who has lent monies to the funds. We already discussed this. Owner is the from the business point of view. Owner is nothing special. He's just an outside party from whom the business has borrowed funds. The business has borrowed funds from the bank, funds from the creditor, funds from other people, and also funds from the owner. We gave it a special name called capital, but then he's just an outside party from the business point of view. That is the business entity concept which we discuss in the second chapter, right? So what the owner does is he takes this 950 lakhs and starts to distribute it. To whom does he distribute? So he'll clear 700 lakhs. He goes to the bank and pays the 700 lakhs. Take the 700 lakhs and close the account. So this is settled, right? Then he goes to the raw material suppliers, some 150 lakhs, right? So he pays both of this, right? And he'll be left with a balance of 100 lakhs. So he has settled all his dues, bank and creditors. So the 100 lakhs, which is left, he'll be taking himself, because this is the capital, the funds which he has originally pumped into this company. This is capital, is the funds contributed by the promoter himself, right? The promoter cannot say I'll run the business entirely with the outsiders funds. Nobody will accept this. As a banker, you will not accept this. Nobody will accept, right? If the promoter says I'll run the business totally by outside funds, so he has to also pump in some money. That is known as the capital. Capital is the funds contributed by the promoter himself towards the business. So sometime in the past he has pumped in 100 lakhs into the company. So now that 100 lakhs is free. So after settling all dues, he has this 100 lakhs. Now he can take this. Now the business has come to an end. The business is terminated. He sold all these assets, whatever in the business, in the name of the business, realized some cash and settled all dues, and balance he has taken it for himself. So this is the scenario. So I don't know whether you spotted this assumption or not. There is an assumption which you made here. So when we said that the company is going to clear all the dues by selling all these assets, so we are making an assumption here. And what is the assumption? The assumption is the company is going to realize 950 lakhs by selling all its assets. So there is an assumption which you are making here. The company is going to realize 950 lakhs by selling all these assets. That is the assumption we are making. Only then we can settle the use of this outside parties, the bank and creditors and the owner. We can only settle the outside use only when we realize this 950. Ultimately, balance sheet is tallying 950 on the assets and 950 on the liability side. To settle the dues totaling 950 lakhs on the liability side, you have to generate 950 lakhs of cash on the asset side. The assumption here is you are able to realize 950 lakhs on the asset side. But for example, you are unable to realize 950 lakhs. What happens then? So under the liability side, you have some dues totaling 950 lakhs, right? Of which 100 is the promoter, bank is 700 lakhs, some raw material suppliers are 250 lakhs, right? Then you have assets, various assets totaling, you sold and realized 950 lakhs. What if you realized only 800 lakhs? What if? Right? What if the company could realize only 850 lakhs, 800 lakhs? What if the company could realize only 900 lakhs? There's a 50 lakh shortfall. So what will happen in that case? So you might ask why that will happen. Now, when the balance sheet is showing 950 lakhs, why are we realizing less than 950 lakhs? There could be various reasons. So one of the items here is something called debtors. So all the debtors did not pay up. For example, out of 200 lakhs debtors, it might happen only 150 lakhs were recovered. 50 lakhs turned bad. You're unable to trace those customers. So what you will do? You realize 50 lakhs short. Or for example, even though all the debtors have paid, when you sold the machinery, you have some fixed assets which you sold. So out of the 400, you realized only 350. Right? You thought you will realize 400, but when you actually went to the market and sold this machinery, the people who saw this said this is old, right? This technology is obsolete, right? It will not fetch 400 right now. Just take 350. You don't know. There could be many reasons why the figures which appear in the balance sheet on the asset side may not materialize, and that is exactly the reason why the balance sheet should always show the true position. So when we spoke of this many times, balance sheet shows the position of a company as on a particular date, but it should show the true position, right? It should not show an inflated position on the asset side, right, or a lower liability. It should show a true position, because if the company were to wind up today, it has to settle the juice of 950 lakhs. And the assumption here is by selling the assets, it's going to realize 950 lakhs. You're depending on the total of the asset side. You're saying machinery, if you sell, you'll get 400 lakhs. Debtors, you'll get 200 lakhs. You're making an assumption. The balance sheet is showing some figure, means you're making an assumption that is the correct position. So you're confident that you're going to recover 950 lakhs. But if you recover something less than 950 lakhs, you are unable to settle the juice of the lenders, right? So you'll fall short by some amount. So that is why balance sheet should always reflect the true position, right? So the other way to look at the balance sheet, we already discussed one way to look at the balance sheet, that is it is a table that lists the sources and uses and funds. The other way to look at it from a liquidation concept, right? When the company winds up, so let us assume the balance sheet, this is the balance sheet prepared as on 31/3/2013, for example. So if the company were to wind up as on this date, the company can realize the total amount of whatever is the figure on the asset side. So whatever the figure is in the asset side total, the company can recover that amount. That is what the balance sheet is saying. And what it is going to do with this amount, it will be settling the juice. To whom the company, what are the pending dues to the company? It will be listed on the liability side. So it will make payments to all these lenders and close the business. This is what the balance sheet is saying. There are 2 points which you should know here. There are 2 points which you need to know here. We're discussing the liquidation concept. Here, there are 2 points which you need to remember. What if there is a shortfall? So in the earlier example, we thought that we'll realize 950 lakhs. We realized only 900 lakhs. So what happens in that scenario? The other point you have to remember is the gimmicks companies play. What are the tricks company play in this regard, right? In this particular regard. So in the earlier example, what we said was the company will realize 950 lakhs by selling all its assets. And there's some juice here. The promoter has initially invested 100 lakhs. The banker has lent some 400 lakhs or 700 lakhs. And there's some 150 from the raw material suppliers. So this is 950. So this is what we said in the example. But now we are saying we could not realize the entire 950 lakhs. We could realize only 900 lakhs. So there's a shortfall of 50 lakhs. So now the promoter cannot say, since I brought in 100 lakhs, I will first take my 100 lakhs out of this 900. So out of this 900, I will first take my 100 lakhs. The balance 800, you to fight it out. So these two actually, 700 plus 150, this 850 to be paid to the bankers and the raw material suppliers. And what the promoter says, I will take my 100 lakhs first, and with the remaining 800 lakhs, you fight it out. So there is a juice to be paid of 850 lakhs to the banker and the raw material suppliers, but the available funds is only 800. So what he says, you share that 50 lakhs loss. So what he says, you take out of 700, since 700 is due to you, right? You take only 675, right? You take only 675. And the raw material supplier 150, you take only 125. So that will be 800, right? So you share the loss. Will the banker and the raw material supplier accept this, right? They will not accept this. We already discussed the loss has to be borne by the promoter. That is the business arrangement. These are just the lenders. These are the people who provided loans. Ultimately, the loss has to be borne by the promoter. So if you could realize only 900 lakhs, even though the balance sheet has told you that you're going to get 950 lakhs, but if due to some reasons you could realize only 900 lakhs, the people who are going to have the first claim will be all parties other than the promoter. So you have to first settle the 700 to the banker, 150 lakhs to the supplier, 850, and whatever is the balance left 50, only that will be going to the promoter. Even though he initially invested 100 lakhs, he is going to get only 50 lakhs. So that is the nature of the business. Yes, his capital, he's lost 50% of the amount which has pumped in. Fine, but that is the nature of the business. The losses has to be borne by the promoter. So here is a term which we need to learn. That is the owner's claim is a residual claim. Why we are saying that the promoter's claim is a residual claim? After settling the dues of all other parties, right? After settling the dues of all other parties, whatever is left will be belonging to the owner, right? Why we are saying it is a residual claim? The reason why we are saying it's a residual claim is only after, right? Only after settling all dues of all other outside parties, right? only then, only after settling the dues of all outside parties, only then the owner will come into the picture. Then whatever is left, right? Whatever is left, only that leftover amount will be belongs to the owner, right? So in the earlier example, 900 lakhs is the amount that could be realized by selling the assets, but the claims were 950, bank 700, raw material supply 150, capital is 100. All the three people are competing for that the share of the juice. So 900 is there, but the claim is 950. So the people who have to get the first claim on these assets will be the outside parties, bankers and the raw material suppliers. So 850. The balance 50 goes to the owner. This is the residual portion. This residual portion. See, this residual portion goes to the owner, and that's why we call the owner's claim being a residual claim, right? So I told you that I'll tell you 2 points. One is the residual claim, and other is the gimmicks which companies place. So let us see we've seen this part. Let us see this part. So we see in that the balance sheet we have the liabilities and assets, the sources of funds. So you have some various items here like capital 100 lakhs, bank loans 700 lakhs, raw material suppliers, creditors 150 lakhs. So various items on the liability side, various assets here like fixed assets, land, building, machinery, right? Inventory. Let us say this is 400. Let us say this is 250. There's some debtors here. Let us say this is 200. So 850. So some cash. Let us say 100. So this is the position of the company as on today. See, you have to understand that the company will never say it owns a higher amount. So when the company prepares a balance sheet, it will never say by itself, on its own, it will not say we owe a higher amount. It will not say. So if it owns 700 lakhs to the bank, there's no fun in showing 750 lakhs. This is a payment which the company has to make. So by making the balance sheet public, it is saying we owe 700 lakhs to the bank. It will not show 750 lakhs. It is foolish on the part of the company. Why it will say it needs to pay 750 lakhs when it actually has to pay only 700 lakhs, right? So there's no way the company will fudge these figures, right? Since balance sheet is a public document, all stakeholders will be having a look at the balance sheet. So raw material supplies, if the company owes 150 lakhs, it will show 150 lakhs, right? It cannot show less than amount also because they will be questioning him. If you're a banker who have lent funds to the company, and the bank and in the bank funds column you are shown only 600 lakhs, you will question it. When you are presented the balance sheet, you will ask the company as on 31/3/2012, as per a system, as per records, you owe 700 lakhs. Why you are showing only 600 lakhs? They will question it. So since balance sheet is a public document, you cannot fudge the liability side, right? There is no fun in showing a higher amount because in that case the company itself is telling we owe more amount. There is no fun in doing that. They won't do that, nor they can show a lower amount because there will be question. The parties will be questioning them. So usually the liability side will not be fudged, right? But on the asset side, a lot of gimmicks take place. You see here, the company has to ultimately pay 950 lakhs. We're assuming that if the company winds up today, it owes a total of 950 lakhs to the outside parties and the promoters. So there is no way that the company can show less than 950 lakhs. So if a company could sell today all its assets and realize only 800 lakhs, it's a bad situation. So as a banker, you will question. So for example, really, if the fixed assets were sold today, let us assume hypothetically, if the fixed assets were sold today, the company will realize only 200 lakhs. The company knows this is a true position. This is a true position. The company knows the machinery are old, obsolete. It will fetch only 200 lakhs. The inventory, it knows it will fetch only 150 lakhs. This is a true position, right? Okay, debtors are there, some 200 lakhs. So 400, 550, cash is 100, 650. So the true position is, if the company were to sell its assets today, it will realize only 650. It knows it. The true position is 650, whereas its dues are 950 lakhs. This is what the company knows. So what if it cannot present this situation. We said it cannot reduce the liability side. So it cannot bring the 650 and it show the liability is 650 because the stakeholders will object. It cannot say bank will own we own only 500 lakhs to the bank, right? We only own 50 lakhs to the raw material supplies, and arrive at 650. It cannot do that. So there will be question. So liability side it will not touch. So what it will do? It will increase this asset side. Usually the fudging happens in the asset side. So what the company says, even though the inventory is 150 lakhs, it will show it as 250 lakhs. It can do that because inventory valuation is something which have a lot of flexibility. There are various methods the company can follow. FIFO, LIFO, weighted average. There are various methods which we'll discuss, which the company can follow. And just by changing the inventory method, you can arrive at a different inventory value. The stock quantity will be same. For example, 100 tons, right? 100 tons is in the godown. But the value of this 100 ton, to arrive at the value, you have to multiply it with some rate per kg, per ton. What is the rate? This value you can arrive at a different figure by assuming a different value here. So there is no sacrosanct. So there are some guidelines. Okay, there are some guidelines as to what is the rate you have to follow. But companies can fudge this figure by following a different valuation methodology. They can arrive at a different valuation amount. So even though the company knows it will realize only 150 lakhs, it might show 250 lakhs. Similarly, for example, it's only 200 lakhs here, but the company is saying will realize 400 lakhs. For example, land, the company might say, for example, we already discussed this while discussing depreciation. So the company might actually depreciate its assets slowly, right? Actually, the depreciation needs to be shown at, for example, the correct depreciation 20%. Maybe the company is applying only 10%, thereby showing a higher return on value. We don't know. See, we don't know what the company is doing. The point you need to remember is the liability side are usually not fudged, but on the asset side, companies will usually resort to inflating the figures, right? So you need to be very careful on the asset side. When you are given a balance sheet, you have to be very careful with the inventory, first of all, very careful, and especially with regard to fixed assets also you need to be careful, right? The reason being, these are two items that are prone to fudging, right? And because these are very important items, usually in the balance sheet, we already discussed, there will be an item called significant accounting policies. This we already discussed. There will be something called, besides the financials, besides the numbers part, you have a qualitative statement spelled out by the auditor. There will be something called significant accounting policies. There you will be actually, the auditor will be specifically commenting on the valuation method employed by the company for inventory, valuation method of inventory, and also the depreciation, right? The company will be the auditor will be specifically commenting on this. So you need to peruse the significant accounting policies very carefully. Even if nothing is pointed out in the significant accounting policies, even then you need to be careful. Just have a rough idea. You see, by the balance sheet, you'll be having something called finished goods. For example, finished goods, raw material, some value will be given. So you know the activity of the company. What is the finished good the company is engaging? Let's see, steel, right? So, for example, you know the prevailing rate is around 45,000 tons. Let us assume the steel rate is 45,000 rupees per ton. So you also know the quantity details. If you are truly into rate monitoring, the company has to submit various statements like MSOD and various other statements, QIS, FFR, right? This both the same. So there are various statements you can track the company, the performance in the company, the monthly sales, the monthly production, right? So even if this figure is not available from the balance sheet, you can know this figure either by pursuing with the company or by some other sources. So by the end of this, for this year, you know what is the ending quantity figure. Or if you have conducted unit inspections, right? Because unit inspection is also part of credit monitoring. So before sanction, you'll be visiting the unit, you'll be seeing what is the quantity of stock. So you'll have a rough idea what is the quantity. You know what is the prevailing rate, and just try to multiply and see what is the rough value you have to get here. And if there's a very wide variation, you can actually spot this. If there's a very wide variation, you know something is wrong, right? Either the company has taken a very high figure or it is reporting a higher quantity details. See, the value inventory is simply the product of quantity minus quantity into rate per ton, right? So this is the formula. So if you're having a higher inventory value, if the company is reporting a higher inventory value, either it is showing a higher quantity or it is assuming a higher price while calculating the value. So you need to question both this. You will also be having access to statements such as stock audit reports and other statements. So the various ways in which you can ascertain whether the valuation is correct or not. But irrespective of these external statements, as a credit also, you should also be satisfied with the figure. So you independently you try to ascertain whether it's a reasonable value, the inventory, right? And the fixed assets also. When we come to the reserves and surplus, which we'll be discussing shortly in a few lectures from now, the company can increase the value of fixed assets by something called revaluation. For example, the company has got land and building, and there are some values in the balance sheet. The company can revalue these assets, right, and increase the value. Thereby, the asset side will go up, and correspondingly on the liability side, it will be creating what is known as the revaluation reserve. Right. This we will discuss when it comes to the reserves and surplus in a subsequent lecture. But the point is, the company has got a lot of avenues to increase the artificially. See, this is a valuation which artificially it can increase the value of various items under the assets. It could be inventory, it could be fixed assets. The various ways in which company can increase artificially. So we are saying that balance sheet should always represent the true position of the company. This is something which I was telling from the beginning. The balance sheet should always reflect the true position. But if the company resorts to such gimmicks, so you will be having a unfair picture. It's not a true picture, right? But unless you know the true picture, you should not be satisfied. So there are ways in which you can ascertain whether this valuation on the asset side, especially on the asset side, right? Liabilities, we said that usually the figures will be straight down, usually will be correct. But on the asset side, the various items, each and every item you should be scrutinizing, especially inventory valuation and fixed assets. And these two, the auditor will be commenting. Definitely he'll be commenting if there is something wrong, something strange happening. The auditor will definitely be commenting in the under the significant accounting policies. If there is a change in accounting policy or any other something is happening, definitely the auditor will be commenting. But irrespective of whether the auditor comments or not, irrespective of whether the stock auditor comments or not, you should be independently in a position to ascertain whether the figures presented under the asset side, that is especially the inventory and the fixed assets, are true or not, right? So I will just now I will now run you through the slides. All of this we have already discussed. I'll just run you through the various slides, right? If you want, you can pause the slides and pursue each and every point. But we have got all of this. So we discuss what is liquidation. So if the company is terminated today, how is the company going to pay all the pending dues? How is the company going to pay the funds? That is what the balance sheet is going to tell you, right? So here we are taking an example. So the company has so many assets. And the assumption is, if it is going to sell all its assets today, it's going to realize 100 lakhs. So what the asset side of the balance sheet tells you, it tells us if we today sell all the belongings of the company, right, in the market, we'll realize an amount of 100 lakhs. This is simply what the asset side of the balance sheet represents. The asset side of the balance sheet represents if we were to sell all the assets appearing under the asset side, we'll realize an amount of 100 lakhs, right? That is what the assets tell you. So what the company does with this 100 lakhs? So it has realized 100 lakhs. What it does, it repays all these people. So it has available term loan of 25 lakhs from the bank. Outstanding, present outstanding is 25 lakhs. OCC outstanding is 15. Some raw material creditors. It has to pay some statutory liabilities like income tax. Some salaries are due. Electricity bill is due. So all loans of friends and relatives. So various other people. So these are all the dues which the company has to settle. So the liability side will be telling, once the company realizes this amount by selling all these assets, what is going to do with this? Is going to settle these dues, and whatever is left will be going to the owner. So what the liability side of the balance sheet tells, the liability side of the balance sheet will tell if today the company were to liquidate it, who are all the people the company has to settle the dues. This is simply what the liability side of the balance sheet represents. So we also discussed the concept of residual claim, right? This is something which we already discussed. So if there is a shortfall, if the assets are 100 whereas the liabilities were 110, so there is a shortfall of 10 lakhs. This 10 loss has to be borne only by the owner. So whatever is left after settling the dues of all other outside parties will be belonging to the owner. The residual, whatever is left behind after settling dues of all other parties, will be belonging to the owner. So the owner's claim is known as the residual claim. So we also discuss what are the common gimmicks that companies usually play. Liability side are usually stated as they are because they are the stakeholders will be questioning it. But on the asset side, usually the inventory and the fixed assets the company will be trying to fudge around. So here in this example, the assets are 355 lakhs. So the company, if it sells these assets, sells the inventory, it will raise 125 lakhs. Fixed assets 150. Debtors, dues from the customers is 75 lakhs. It has got already a cash of 5 lakhs in the bank. So altogether 355 is going to be realized, and it's going to settle this 355. What is going to do? It's going to repay unsecured loans. It's going to settle the dues to the bank, term loan and OCC, some raw material creditors, and the balance, the owner's claim. We'll discuss this. Both the capital and reserves belong to the owner. This is known as net worth, right? Net worth. So ultimately, after settling all these dues, will be left with 180 lakhs. This will be settled. This will be taken by the owner, assuming the company is going to realize 355 lakhs by selling all the assets. But for example, if the inventory shown as 125 generated only 75 lakhs, right? So the cash from all the sale of the assets has realized only 355. That balance 50 lakhs shortfall has to be borne by the owner. So this is what residual claim is. This we already showed. So you have to be very careful with the inventory, whether inventory valuation and the all assets, basically inventory and the fixed assets, right? So because balance sheet is going to tell you if the company were to dissolve today, what is the cash you're going to realize by selling these assets, and these assets, this cash will be going to settle the dues of the customers, right? Dues of the various parties. So balance sheet should reflect the true position, and when we say true position, the assets, especially inventory and fixed assets, should be correct, right? So with this we come to the end of this segment 6.1. So in this segment we have discussed what a balance sheet is, right? The concept of balance sheet. So hope now you are comfortable with what a balance sheet represents. See, there are two ways in which we can look at a balance sheet. One is the balance sheet is a table which represents what are the sources and uses of funds, from where has the company obtained the funds, right, and what it has done with the funds. So sources and uses. The other way to look at it is from the liquidation point. So if the company were to wind up today, by selling its assets, what are the funds it will realize, and and with these funds it will be settling the dues of the various parties. So who are those various parties? That will be listed in the liability. So these are the two ways in which we can look at the balance sheet. We have discussed this. We have discussed that in this chapter. So in the next segment 6.2, we'll be starting with our item-wise discussion of balance sheet. We will be taking each and every item that can appear in a typical balance sheet, and we'll see the accounting treatment, the treatment in the CMA. What are the points that you need to be careful when you encounter a particular item. So in the next segment, the 6.2, will be starting with capital, right?